In the mortgage market? Join us for another episode of FDM Brews to learn more about trends and updates in the mortgage industry that can help you get your clients pre-approved for the home of their dreams.
Good morning, gentlemen.
Good morning, Cindy.
So what's brewing with you this morning?
What's brewing? It's spring. It's 70 degrees. It's awesome. It's 8 o'clock in the morning. I got coffee and we're talking about real estate. It doesn't get any better than that.
You know, keep the hot market with keep the hot market burning with some caffeine and let's kick it into high gear, right?
Kick it into high gear. We need coffee to keep up with the momentum of the market.
You know, just when we think things are settling down or settling into a routine, I just think that the market's like, hey, time for a little reality check. And I think you've got some important updates to share with us about the condominium market and some of the rules and regulations that we were forecasting a few weeks ago, but have come to fruition at this point. And
absolutely, Cindy. We talked about it before. We knew that there would be some unique challenges with Fannie Mae and Freddie Mac's changes to condos. And we did a nice little training about it. And unfortunately, just like with anything else, when these things actually rolled out, it became a lot more difficult than anybody anticipated. So we wanted to have a refresher, talk to everybody a little bit about what we've learned as this process has kind of moved forward, right? We kind of had an idea of what would happen. Unfortunately, as challenging as we thought it was going to be, it ended up being a lot more challenging than we thought it was going to be. And we just kind of want to touch up on why these things are occurring so everybody can articulate that to their clients, both buyers and sellers. And number two, kind of reinforce the best practices, because what we're finding is that there is kind of a standoff between condo and homeowners associations and what Fannie and Freddie want. And let's just say that challenge is getting saltier, right, of what people will do and how they do it. So we're having some very interesting discussions with condo associations and with the agencies, right? One saying we're not going to do it, and the other saying, well, if you don't do it, you're not going to get the loan. Like, everybody's stuck in the middle. So we just kind of wanted to go over why things are happening again so everybody understands it, and then just kind of brush up on some of the best practices so we can make this a smoother process.
Absolutely. And, we had also talked a little bit about uniquely in Southwest Florida, the market has these multi-million-dollar condos and then, entry-level condos or condos that are more geared towards your working professionals. So I think it impacts everyone, though, in the ability to sell a home, right?
It really does. And what's interesting is, and you brought up a good point. So especially in your market, right, you have multi-million-dollar condos, and we know that in your market, actually, it's one of the top cash markets in the country. So a lot of times the upper end, people are paying cash, so maybe this isn't affecting them. When you're looking at the entry-level market, where when you look at surrounding counties, the condo can be a lower cost entry for first-time home buyers. They're the ones that are really getting hit hard by this, because if you don't need financing, then Fannie, Freddie or not, their rules aren't impacting you. For when you're coming into the market and you're looking at this as a low-cost alternative, and then you're getting hit by these challenges, it becomes really, really emotionally draining, and the process becomes longer, and you can get discouraged in that. So while we know the condo market in your area is broad, right? We know that people are probably hit the hardest are the folks coming into the market the first time and looking for a lower cost entry into the marketplace, and they're getting hit by the Fannie Freddie condo rules hard.
Absolutely. Well, shall I bring up your presentation?
Absolutely. Let's get talking about condos in the morning. Yay.
Nitesh, did you want to take it?
We will take it. I'm going to pull it up here and let's go. So like we're talking about the Condo Conundrum, a Redux. We're going to go over things again and talk about what we've learned.
Yeah, we want to talk about, I know we've been through this before a few weeks ago, and in those few weeks, there have been a lot of changes, and we want to bring those changes up and see how, it's continuing to impact the real estate market and, some options that we may have to get it resolved. And as we discussed, so condos, and as Cindy brought up, in the Naples market, it's very broad. There are folks who are buying multi-million-dollar condos, but then there are also individuals who are looking at condos as a starter home. And condos have been very popular regardless of the type of market you're in. We talk about it a lot, Brett and I, where condos are a lifestyle choice. It's for right sizing. There are a lot of folks who, had a 4 or 5 bedroom home with kids and, large family. And now kids have gone off to school and they're looking to right size, right? Not downsize, but right size. And condos are a great option for that. Let go of the $5 million, home and use the cash, which we're seeing a lot in the Naples market, where cash is being used for real estate purchases. Use that cash and buy condos. It's also been very popular for second home markets, even investment. Two of the current trends, as we've seen since COVID started, folks are able to work from wherever they want. Teleworking is easy, and a lot of companies have gone permanently to remote work, and that's given a lot of people an advantage where you're selling homes in the Northeast and you're using that cash to come down to Florida and buy properties, and condos have been very popular in that. And as I mentioned, baby boomers are selling off their large homes and they're right sizing and buying condos, which are maintenance free, headache free. Somebody else is taking care of the property. They're only worried about the wall to wall maintenance, where somebody else is taking care of the rest of the property.
What's interesting there, Cindy, when we talk about two of the current trends, right? The second trend where, older folks have migrated to Florida and some traditional second home markets in retirement and looking at lifestyle choices, whether it's a lower cost of taxes, right? That's always been in place, right? That's why Florida has always been a destination for retirees, right? We know that that's just been a phenomenon that's been in place since I've been in the business since the 70s. What's changed it and what's kind of thrown lighter fluid on the fire is the change of the hybrid work revolution. Right now, people, and we're seeing it now, people that used to have to work in New York City, they don't have to now, right? They're working remote, right? They're working virtual. It's Zoom work, right? And they're saying, well, if I'm going to do that, I don't need to be in New York City. I'm going to be in Naples, right? So that's kind of put lighter fluid on the extremely hot housing market. And, obviously condos are in big demand there. And, that's why we're running into some of the same challenges we have. So we have two trends that are really accelerating the market at a time when some of the things that recently happened have created challenges in condo financing.
So traditional flashpoints for condos, for anytime you finance a condo, there's a condo questionnaire that's required, and there are some questions asked of the condo association as to the status of the condo association. And again, the traditional questions have been what percentage are investor owned, and what percent are owned by a single owner, and how many units in that community are delinquent, and then if any, what percentage is commercial or non-residential. Is there on-site rental management? So these are the questions that again, traditionally used to be asked, and now with the changes, we're seeing these questions still exist, but there have been new questions that have been added on to this.
Yep. So on this one, Cindy, a couple of things. These traditional flashpoints, right, have always been part of the condo questionnaire. Now, because of COVID, these things are still flashpoints, as Natisha just shared with you, right? Because of recent events, there's other questions that are creating difficulty. But I want you to focus on two things here. What percentage of owners who are delinquent on their condo fees, right? When the CARES Act happened, people didn't have to make the mortgage payment. When they didn't make their mortgage payment, they stopped making their condo payments as well, condo association payments. So delinquency shot through the roof, which is putting stress on reserves and other issues. So delinquencies, we're seeing a lot of delinquencies in homeowners association fees. That creates a problem. The other part is what percentage of units are owned by single owners and investors. Why is this an issue? Heavy investors, right? And because investor real estate, we did a training before about 20% of the market is expected to be non-owner occupied or investment transactions. So investors are buying properties, and then hedge funds and investment funds are buying them. And a single owner who owns a lot of units, if they go under, right, then that's going to impact the budgeting and the reserves, because if they go delinquent, then they are not making the condo fees, and that can impact reserves. So these are traditional flash points. They're still flash points, but they're just now part of something else that's added onto it that's been created by one specific event.
Yeah. So, and the event that Brett's mentioning is unfortunate, collapse that happened of the Champlain Tower South in South Florida. It was about, I believe it was last summer when it happened, and that's brought about a lot of changes in how condos are looked at for financing purposes. Previously, the focus was on financial stability. You ask questions within the questionnaire that had specifically to do with financial stability of the association. Now that's changing. It's we're still asking those questions, as I mentioned before, but now the focus is becoming structural stability of the condo itself. And the new questions that are being added are pertaining specifically to that. And everything that we used to do as lenders have changed, and it's not just impacting lenders. It's impacting everybody in the real estate market, everybody that's involved in that transaction of the purchase of a condo. Condo approval process, of course, has been much tougher due to this. We used to have something, if someone was purchasing a condo and they were putting a high down payment, and they had great credit, great reserves, good income, Fannie and Freddie would look at that information and say, okay, this is a strong buyer, and this is a safe transaction because it's high down payment, low loan to value. And they used to offer something called a limited review. And the limited review required less questions to be answered, and less condo documentation were needed for approval. Now that no longer exists. They got rid of that completely. So regardless of how much of a down payment you're putting down, how strong your financials are, and how strong your credit is, you still don't have the option to have a limited review for your purchase. And that's where a lot of changes are coming, because there was a big portion of the market that, even though there was a condo approval process, they didn't go through the questionnaires and the collecting condo docs part of it. Now nobody's getting around that.
To Natish's point, right? So we had an option before where we could do a limited condo review, and there were a minimal amount of questions, and that was easier to get things through. Now the pendulum has swung completely the opposite direction. Now you can't answer the smaller review. We've added multiple pages of greater detail that need to be answered. And because of this unfortunate circumstance, Cindy, what's happened is there's a lot of scrutiny about the structural integrity and the financial stability of the condo association. And when we go through towards the end of the presentation, when we go through some of the questions, you'll see what their focus is, and there's no way around it, right? So these are hard stops, and everybody needs to be aware of that.
Gentlemen, it seems to me that you had an initial trust in the overall management of the condo building, but now it sounds like the trust, or they're being held to the same scrutiny as the buyer in a sense for liability purposes. So
they really are, Cindy. You're absolutely right.
And I don't know, it just sounds like something that a selling or a listing agent needs to probably be very on top of before this even goes to market. So that
you're absolutely right, Cindy. When we go through the best practices, we're strongly encouraging the listing agent to get the condo questionnaire done before they list the property, so they know what challenges they're going to face, because you want to do that at the beginning, right? We always talk about front loading an equation, and that's what we want to do, right? You don't want to deal with this at the end of the issue, because these are dead stops, right? These are hard stops with Fannie and Freddie, and whether we like it or not, Fannie and Freddie really drive the lending business, and in addition to FHA and VA, but they're the primary drivers, right? So we have to understand how to navigate within their requirements. The other thing that we talked about is the CARES Act. And I think this is important because there's always unintended consequences, right? We're helping somebody else, but then what happens after that? So the CARES Act is actually having an impact on condos as well.
It is. And, Brett, you mentioned earlier, when COVID started, everybody was trying to figure out how to help, anybody that needed help. And, the CARES Act was brought about, and it did. It made a huge difference, especially while a big portion of the public, was losing jobs. And a lot of folks were, at home without the income to pay their mortgages. And the CARES Act allowed them to go into mortgage forbearance. They had a period of time where they didn't need to make a mortgage payment, and it wasn't going to negatively impact their credit. However, what that resulted in was when folks weren't making their mortgage payment, they weren't making their condo association payments either. And that caused a huge issue with the budget for the condo and reserves. And, a lot of folks are, now talking about the fact that maybe that is what's caught. And, with the Champlain Towers, that's probably not what happened. But there probably are condo associations out there that are, not focusing on maintenance as much because they don't have the funds to do it. Their reserves are not as flush as they used to be. And because of the forbearance and the delinquency, they don't have the funds in their budget to take care of all the issues that the condo may have.
There's always unintended consequences, right? When things happen quickly, everybody doesn't think through what's happening. And to Natisha's point is when people stop making the mortgage payment, by the way, millions of people stopped making the mortgage payment. And then they were surprised to find when they went to go get new financing that wasn't something that wasn't supposed to impact their credit, actually impacted their credit. You can't stop making mortgage payments and think it's not going to affect you, because it does, right? But that's another story. The unintended consequences are people stop making their condo association payments, right? When then that negatively impacted the reserves. Now, when lenders are looking at, or Fannie, Freddie are looking at and saying, wait a minute, you need to have X in reserves and your significant amount of your homeowners are delinquent, which means you're not paying these. Is that going to impact your ability to maintain the project? Is that going to negatively impact your reserves if you have a deferred maintenance issue, right? So they kind of layer on top of each other, right? Those unintended consequences, and that's just something that happens all the time, right? And this is one of the things that happened. CARES Act was good, helped a lot of people, but then what happened afterwards? And then when you layer that on top of what happened with Champlain Tower South, and now lenders are so, wait a minute, they're under reserved to deal with these issues. We're not going to do the loan. So that's created Fannie and Freddie. Now, Fannie, when we first did this, right, Fannie Mae made their changes in December. Freddie followed in February of 28th, and they rolled out these new guidelines. And this is where we're running into some difficulty.
Yeah, and the new guidelines, it resulted, of course, from the accident, and it's bringing about a lot of changes. FHA and Fannie initially made their changes, and we immediately started realizing that this is going to continue for a while, and there are going to be other changes that are going to continue to happen. And Freddie, as Brett mentioned, in late February, Freddie rolled out their changes. Now, because of the reserve issues that were caused due to non-payment and delinquency, there were a lot of deferred maintenance, projects that were happening. Special assessments started increasing, and the special assessment made it difficult for a lot of folks to qualify because we would do a pre-approval for somebody, and they were approved for maybe around 400,000, and they could afford a condo association payment of maybe $300 a month. Now, because of the delinquency and the decrease in reserves and decrease in the condo's budget, they started increasing their assessment fees, and they started adding on a special assessment. Now, when we're qualifying the borrowers, now you're adding that special assessment to their debt ratios. So instead of now just qualifying for $300 a month in condo fee, maybe there's an additional $200, $300 that they're having to pay. And it may be short term, but that's still an expense, and you have to consider that. And that change in the way condos are doing things and the change in the questions that are being asked, it's impacting everybody. And appraisers are a big part of that. And what we have seen, so appraisers, when they go out, there are a few questions that they're having to answer on the appraisal report as well. Now, what we're seeing is that appraisers are waiting for the condo questionnaire to come back before they're releasing the report to us. And they want a copy of that condo questionnaire to answer a lot of the questions they need to. So, there are times, and Brett will go into this. Condo associations are avoiding answering certain questions, and that is causing appraisers not to be able to answer certain questions. So there's just a lack of information that's causing a roadblock in the lending process. And again, Brett will go into that, but there are some ways to get in front of it, and hopefully we can help the agents out and figure out some solutions for this.
What's interesting here, Cindy, is, and this is one of the pushback points that we're getting, when you get the questionnaire, and we're going to go through some of the questions, right, then that may lead us to ask for the association budget and their minutes. And then the association's going, well, we're not going to show you our minutes. And why don't they want to show us their minutes? Because they don't want to take liability of, hey, they're talking about a structural defect and it's in their minutes and they know about it. And they don't want this public. But on the same token, we see the questionnaire and says, hey, there's an issue. We want to know what the issue is. So this is where it's getting a little difficulty because everyone's kind of running for cover, right? We need information. They don't want to provide the information, and it's creating challenges. And to Natish's point about the appraisals, they need to give data, and then they're taking on increased liability, and they don't want to do that until they see the questionnaire. So it's creating layer upon layer upon layer of challenges that you need to get through. And every time we peel back one layer, then all of a sudden other questions pop up. Now, to Natish's point, special assessments are an issue. Now, special assessments used to just be a financial part. Okay, I have a condominium and they need to replace the roof, so all the units are getting hit with the special assessment. Now we need to understand what the special assessment is for.
Right, and that's exactly the question now. Whereas previously we were just looking at what the special assessment amount is, but now we're having to dig deeper and find out what the need is to have that special assessment be charged, specifically to see if it's to pay for some type of structural damage. And of course, as I mentioned earlier, the special assessment is being tagged on to the qualification of the buyer, and see if they're still approved for a loan with that special assessment added to their debt ratios.
Right. There's two important points, right? Natisha talked about that if there's a special assessment, you have to add that. So you have a pre-qual and it's great, and all of a sudden you have this special assessment that the buyer has to carry. That's going to make the pre-qual invalid. 2 points, really important. The special assessment, is it no negative impact to the financial stability, viability, or condition of marketability of the project? Are they under reserved? Is the special assessment designed to do that? Or is it making up financial shortfalls from delinquent homeowners association? That's when we talked about the previous flashpoints and the delinquency and who's behind and are they under reserved. The bottom one is, if the special assessment is to fund safety, sound, and structural integrity or habitability, the repairs must be completed. So now we get this questionnaire. Now we see they have a special assessment. And we're dealing with one right now, Cindy. It had to do with the foundation. You can't close until the work is done. Well, we're not going to get this done for 6 months. Okay, well, I know your seller wants to sell the property. They've got a property that's that they want to buy, and it's contingent on this one. But the special assessment was to fund a safety issue, right? Okay, you can't do it, right? We can't close, right? Fannie Freddie won't let you close until that work is done. That's very important, because we have a seller, their deal's stacked up. Well, we can't do anything, right? It's a structural issue. Fannie Freddie say no, right? I can't take it from a Fannie, move it to a Freddie, because they're both saying no, right? So you don't have an option. So looking at special assessments is a really big driver. And the next one is another issue of deferred maintenance.
Yeah, the questionnaire now asks significant deferred maintenance. The project is not eligible for agency financing until the repairs are complete. As Brett mentioned, something like a foundational issue, yes, they're saying that it's going to be done in 6 months, but we have no guarantee of that. Fannie and Freddie are looking at it as, well, the issue exists. We don't know when it's going to be complete. You say 6 months, but what if when they do a study or when they start the project, if something else comes up, what guarantee do we have that it's going to be done in 6 months? And, yes, there is a financial aspect of it where they are covering the financing of the project and making sure it's secure. But, everybody has to keep in mind, this is also to keep the buyers and the residents safe. They want to force these associations to complete these projects as soon as possible instead of continuing to defer these projects. And, yes, there's a marketability aspect to it, but safety is the utmost concern. There was a condo that collapsed, and they want to make sure that it doesn't happen again, and that residents are continuing to be kept safe and protected.
The important part here. Oh, I'm sorry, Cindy. Go ahead.
No, I was going to say in Florida, we're used to, right? You can't buy insurance for a hurricane when there's a hurricane in the pipeline, right? So
Very true.
Why would Fannie Mae and Freddie Mac want to take on the risk of this project that's already in the pipeline? So I equate it to that insurance, and that timing purpose. But
that's a great point, Cindy, right? It's no different. So what you have to understand both here, and these are hard stops. If you have significant deferred maintenance that gets identified in the questionnaire, right, or the appraiser identifies it, or if an authority has told them they need to make repairs, they cannot get a loan until they're complete. Now I hear, well, my seller's this, my buyer's this, they have no place to go. Well, this is why we want you to get it done first, so you know what you're dealing with, right? These are hard stops. The loan can't get done. If you have either one of these items, you can't get it financed until the work is complete. It takes 30 days, great. If it takes 6 months, it's going to take 6 months. You're out. So what's happening?
Well, one thing, Brett, I want to add to that is, this is new for condos. Well, folks may think this is new for condos, but you got to keep in mind that if you were purchasing a single family house, there's an inspection done on that home. And if the inspection comes up with any issues, if there's a foundation issue on the inspection, Fannie, Freddie, FHA, VA, nobody's going to allow you to close on that loan until that's resolved. If there are any safety issues with a single family home, nobody's going to allow you to close. With a condo, the inspection is not looking at, it didn't used to be where the inspection is only looking at wall to wall within that particular unit. And foundation and the structural, aspects of it were never looked at. And that is now coming into question with the questionnaires and with the documents that are being asked of the condo association.
That's a great point, right? It's always been for single family, and the condo used to be just looking at within the walls of that one unit. Now it's looking at the entire project. So this is something that has just now been implemented for the entire building structure. So it's creating some challenges. So what's happening? When we first did this, Fannie and Freddie was providing clarity. Now they have provided the clarity on what's required, and it's causing major issues. First, appraisers are often unable to find the required data, and they're not willing to answer the questions when they do find the data, right? Because they don't want to take on the liability. So we have an appraisal issue, right? They need to give certain things to meet Fannie Freddie guidelines, and they don't want to do it. The bigger issue is associations have received legal advice that they should not answer the required questions, and they are following that advice. So we talked about it, right? It's a classic catch-22, or I call it condo chicken, right? It's like the homeowners association, condo association on this side of the road, Fannie and Freddie are on this side of the road. They're heading towards each other, and no one's going to blink, right? I've had discussions with the condo association saying, hey, this is great. You don't want to do this. That's fine. No one else is going to be able to buy your unit. And they're going like, yeah, talk to our legal counsel. It's kind of like the Saturday Night Live, like talk to my hand, right? Yeah, that's fine. Talk to my hand, because I'm not answering the question. Fannie and Freddie are going, well, if you don't answer the question, we're not doing the loan. And this is going to take time to work out. So how do we get ahead of it, Cindy? We talk about front loading the equation, right? How do we get ahead of these things? And we brought these up before, but I think it's imperative that we bring it up again because we did get some pushback. Well, my buyer doesn't want to pay for this because, oh, fine, you get a loan in process, we get the appraisal in, we get the condo questionnaire, and now we're going back to you and say, great, you know what? I know you invested $700 in the appraisal and $300 in getting the condo docs, and your loan can't get done, right? So maybe we strongly encourage them that the best practice is to get this stuff done up front. So the first thing we want to do, if you are a lister, and I think this is critical, I think it's important, we highly recommend it, and this should be common practice, right? If you have a condo listing, get the Fannie Mae Condo Questionnaire with the Condo Addendum completed before you market the property. Two things are going to happen, Cindy, when I'm going to show the questions that they don't answer, right? The HOA or condo association is going to come back and they're not going to answer it. Okay, then we know, Natisha and I know, and your lending team and the realtor team know what we need to do. Okay, do we push back to the condo association? Do we say, hey, this is going to limit the financing options? Do we have to look at alternative financing options before you market it? You want to do this before you start accepting offer. If you're working with a pre-approval and the listing agent and the seller did not get the condo questionnaire done, get the condo questionnaire completed before you submit an offer. Now, everyone's bidding on this and I don't want to do that. Well, okay, if 20 people are doing it and 20 people need financing, they're all going to face the same challenge, right? So let's be professional in the process and understand, let's get this quantified. Let's find out what we're dealing with so we can make an appropriate offer. If you're working with a pre-approval, make sure the association fees do not impact the pre-approval before you submit the offer. Now, what did that mean? When Natish brought it up, if there's special assessments that you're not aware of, you know what the condo association fees are, and then all of a sudden there's a special assessment that your buyer has to carry, do they still qualify? Well, the only way to find that out is, I don't know, get the condo questionnaire completed, right? So it's really, really imperative that you take this step, because here's what's happening, right? This is a real life example of what's happening in the marketplace today, right? So I'm highlighted questions that need to be answered, and this is a real life coming back from the Homeowners Association. Number 4, are there any outstanding violations of jurisdictional requirements, zoning ordinances related to the safety and soundness, structural integrity, or I'm having trouble with that word this morning, darn it. And they don't answer. They say, see comments. Okay, well, see comments doesn't work. Is it anticipated that the project will in the future have such violations? Quote, we encourage lenders to contact the state and local regulatory inspection agencies to determine if notices have been made to make repairs to unsafe conditions, violations have been delivered, will be delivered to the Homeowners Association. So basically, we're not answering it. You go look up the regulatory. Now, the problem is Fannie and Freddie aren't taking this unless it comes from the Homeowners Association. We have gone to Fannie and Freddie because this is a real live issue of a loan I can't do right now. We've gone to Fannie and Freddie and said, okay, what if we look it up and we answer the question? Fannie and Freddie said, no, it needs to come from a Homeowners Association. That's where the game of chicken's coming in, right? They're saying, no, we're not going to let the answer to it. Does the project have a funding plan for its deferred maintenance or components? Natisha brought up issues on one slide about deferred maintenance. They're not answering the question. See comments. Does the project have a schedule for deferred maintenance and components, items to be repaired or replaced? Please refer to the meeting minutes budget report for this information. Well, they don't want to give us the meeting minutes, right? So you can see where this is becoming a problem. And this, like I said, is a real live event. Does the last inspection have any findings? We're not answering that question, right? The HOA cooperative aware of any deficiencies? We're not answering the question. They give you this template, boilerplate template. And what this boilerplate template basically says, Cindy, is we're not answering anything. And you're giving the lender the information to make a prudent underwriting decision, but we're not answering anything. This is where it's a catch-22. They don't want to answer anything. They're giving us this boilerplate template, which basically says we're not answering anything. Fannie and Freddie are saying the lender can't answer it. It's got to come from the Homeowners Association. And who gets stuck? Our buyer, right? So this is real life what's happening. I'll share a funny story. On this exact transaction, I was going back and forth with the Homeowners Association, back and forth. And I was thinking maybe I'll copy this because they sent me it was one of those chat box thingies. They sent me a an email which summarized the entire conversation. They could see me and her and me and her. The final one was Brett, comma, in bold. We are not changing any of the answers. Exclamation point, thank you. And that's how our conversation ended. So, it was back and forth, back and forth. Finally, I guess she had had enough. She got salty. Bold, cap, exclamation. We're not changing any of the questions. Okay, thank you. So we're kind of stuck. So we really, really encourage get this done before you list the property so you know what you're dealing with, and we can come together with solutions. So when you actually sell it, you actually have a contract, we have financing alternatives for them unless paying cash. Now, if somebody's paying cash, none of this comes into play. Right now, for half of the market in Naples, right, people are paying cash, fine. But what do you do with the other half of the market, right? And at some point in time, Cindy, not everybody's going to pay cash, right? And, hopefully we're going to share another class about that. But what do we do when that happens, right? So let's prepare for that in advance.
Brett, you made a point and you said the buyer's left holding this, but really it's the seller who's left holding the property that they're no longer interested in holding. So, I'm coming back to this is really that responsibility. It's a joint responsibility of all
Absolutely.
real estate agents. This has got to be done, at listing to know that anyone who's going to make that offer is going to
and we discussed it before, Cindy, that there's a marketing advantage to that as well. You get a listing agreement from a seller, and as an agent, if you do that condo questionnaire and get all the condo documentation up front, well, now you already know there's no issue, and you can market that property from the get-go. You can list it as hey, this property is Fannie Freddie approved, condo questionnaire already completed. And it's going to attract a lot of folks because the public is aware of what's going on. The industry is aware of all these changes happening. And, folks are a little bit reluctant if they need financing and they're looking at condos. They're scared to, find out what's going on and what the questions are and how they're being answered. And if you've already got it completed, then you have taken care of 25% of what needs to be done. And, again, as we discussed, appraisers are requiring this as well. And instead of having the appraiser wait at the 11th hour for the condo questionnaire to come in, you have the questionnaire. And when you're ordering the appraisal, you can submit it with the appraisal order so that by the time an appraiser picks up that inspection, they already have the questions answered. They already have everything they need for their report. So, getting in front of it is going to help the sellers, the agents, the buyer, everybody involved in the process.
Mm-hmm.
It's a challenge. If you look at this addendum question 3, basically it's telling you Fannie Mae is asking for this, so what? We're not going to give it to you. So that's kind of what we're dealing with. And Natish's point, Cindy, your point about the seller, I was going back and forth kind of correspondent with the agent. Well, my seller, they have these deals stepped up, but what are you going to do? And I'm like, well, there's not much we can do because my suggestion is have your seller go into the condo association and tell them you need this because this buyer doesn't have an option, right? We do have non-QM options, but non-QM options require a larger down payment, right? So, and our buyer doesn't have that. So if we had identified these issues before the contract was written, then we could have either worked with the homeowners association to try to get the answers done quickly. And I don't think they're going to answer it now anyway, or maybe she wouldn't have, made an offer on this condo and looked at a different one. So it's going to be a while for us to work this out. That catch-22 is going to last for a while. So we're really reinforcing the best practices. Get this done before you list the property. Get this done before you make an offer so you know what's available, because you don't want to deal with what we're dealing with now, which is somebody at the end of the process, the seller needs to sell the property to buy another house. Our buyer really, really wants this property, and Fannie and Freddie won't finance it until we get these answers done. So we're trying to find alternatives. I mean, honestly, Cindy, last week, Natisha, I went to a condo association management company, sat in their lobby to try to get one done, right? And that's kind of hard to do when you're doing, millions and millions of dollars of loans every month. I can't go to every condo association and sit down there and camp in their lobby and try to get it done. But that's what we do to go above and beyond. But we like to try to get these things done up front.
Now, you said there's going to be some shakeout. Do you think that once the condominiums are brought into a period with their attorneys, that they feel like a little more solid about the answers and the liabilities, that this is going to shake out and get easier in a year or so, or do you think this is just the new normal, like another phase of the new normal in the real estate market?
Cindy, that's a good question, right? So, I kind of talk about this when I teach other classes, like who blinks, right? So when condo associations, realize that their sellers can't sell their properties, or there's a limited pool of buyers to cash buyers or somebody that will qualify for non-QM, okay, what are they going to do? Pretty soon sellers are going to go, well, wait a minute. I know my HOA doesn't want to take this risk, but I can't sell my condo, right? Okay, that's going to create some change. The market provides solutions. So, and we've already had these discussions. Okay, we already know non-QM doesn't require this yet. So there's a challenge, and non-QM means non-qualified mortgage. So it's not a Fannie Freddie product, right? So, okay, are they going to fill the void? Now, the question that you have there is, are they looking and say, are we willing to take the risk that there might be a structural issue with this condo, and we're not going to ask for this because we think that we're okay, because 99% of the condos are going to be okay, right? So are we willing to take that risk? Now, the buyer's going to pay for it, right? They're not going to do that for Fannie Mae, Freddie Mac rates. So they're going to pay higher rates, which may impact the marketability of it. See, all of this will flash out, right? So is the market going to step in and find alternatives? Probably. Are sellers going to come back and push back and say, wait a minute, I can't sell my property because you're not going to answer the question? I don't think Fannie and Freddie are going to blink, right? I think Fannie and Freddie, because remember, Fannie and Freddie went through some challenges in the mortgage crisis, right? So I doubt Fannie and Freddie are the ones that are going to blink. They're going to sit there and say, you know what? We don't finance condos, right? There's more than enough business out there for us. We don't want to take this additional risk, right? They're already putting in price hits for Fannie for condos, because that tells you that they're limiting second home buyers, they're limiting investment buyers, and they've already put some price hits on condos anyway for this. So I don't think Fannie Freddie blink. So it's either going to be the HOAs from pressure from the seller, or the market coming in to say, okay, we'll fill the void, but then your buyers are going to pay for that. So I think this is going to flesh out over the year. But initially, the initial shock to the system is pretty dramatic. And we all need to understand how to work through that, because you want to get this done before the loan and the contract get in process, because you don't want to be dealing with this at the end.
Absolutely. It's a lot to consider and a lot to work into business, but I think, the ultimate takeaway is get it done quick and front load it and definitely take your business to the next level, and by making sure that these best practices are being followed.
Absolutely, Cindy.
I think the other big call to action is reach out to FDM, because you guys are there to help with the buyers and help with the sellers and help prepare options for our real estate agents to really help and support their clients' dreams. So I think that is just as important in building that relationship and knowing that there are multiple options out there.
Absolutely. Well, thank you, Cindy. Hopefully everybody enjoyed their coffee this morning with such good news.
Yeah.
Cheers.
Cheers.
Thank you for joining us for FDM Brews. Our team is here to answer your questions. Just call 239-359-6590 or email us at dfry@fdmhome.com.